you see my screen? Thank you, Manon. All right, so real quick, I just wanted to look at that example that we didn't have time for yesterday for a gross up going over the additional Medicare tax threshold. So basically you have to do two pieces of it, because part of it is going to be taxed for an additional amount than the rest of it. So for example, Medicare wages of $175,000, employer wants to pay a net bonus of $30,000. So that's going to put them over $200,000, which is going to make them have to pay the additional everything over $200,000. This employs the Social Security limit, so we don't have to worry about that, which is kind of nice. Okay, so here's a very fancy formula for when Social Security wage base has already been exceeded. So X is what we're trying to figure out. That's our variable. And then the 0.22 is the federal supplemental tax rate. The 0.0145 is the Medicare tax rate. The 0.009 is the additional Medicare rate. So we're going to take that 0.009 and we're going to multiply it by anything that's over the amount of 200,000, because that's when the additional Medicare kicks in. Okay, so let's put that into practice. So for this example, we are trying to figure out what X is. That's our gross up amount. We're trying to figure out what that is. So the employee already has 175,000, and we are trying to get $30,000 as our desired net. So if we fill in everything that we know in our formula, we get X minus 0.22X minus 0.0145X minus 0.009 times X minus the quantity 200,000 minus 175. And we want all of that to equal 30,000. That's a lot of math for a Friday. And you've probably been out of high school long enough that you don't want to look at any kind of formula like that, but it does work. So if we take order of operations from a very long time ago, order of operations tells us we do everything in parentheses first. So we're going to take our 200,000, subtract 175, that gives us 25,000. So then inside that set of parentheses, we now have X minus 25,000. If we continue, and of course I had to jump into the next column because I was running out of slide space. So we keep going, we have X minus 0.22X minus 0.0145X minus 0.009X plus 225. So for those of you that loved high school algebra, you just did the distributive property with that 0.009 and distributed it to everything inside the parentheses. I'm taking you back this Friday, aren't I?
Oh my gosh.
Now, one thing that comes up is that 225 that you see in there, that went from a negative 25,000 to a positive 225. And the reason that that happened is because a negative times a negative is always a positive. Again, remembering back to high school or before, if you worked with negative numbers back in maybe middle school, then a negative times a negative is a positive. So that's why that became a positive amount. So then if we take all of the things that have an X in front of them and we can, or behind them, I should say, and we combine them together, we get 0.765X is equal to $29,075. So we combined all of our things with an X and we subtracted 225 from both sides to keep our equation balanced. So much math. And then we're going to divide by 0.7565. And that gives us our answer. So it's a backwards way of doing the exact same formula that we were doing yesterday for the gross ups. So it's kind of ugly, but it works. So here it is in more of a view of how we did it yesterday. So we have X is equal to the desired net minus, and then we have to take into account the amount that goes over that $200,000 Medicare limit. Because that's going to change the taxes that we have to account for the bonus. Okay. Again, I always recommend that you verify your result on these gross up calculations because that's the way you can verify and guarantee that your answer is correct. So if we look at the verification, we came out with an answer of $39,358.89. If we take 22% of that, we get our federal income tax. If we take 1.45%, we get our regular Medicare. If we take 0.9% of only the amount that went over 200,000, then we get 129.23. And if you take your gross and subtract all those taxes, you do in fact get $30,000 net. So those gross ups can be challenging. Take your time is really my biggest advice on that one. This is just another way of looking at it. I'm not going to go into too big of depth on this, but it's the exact same idea, just a different way to look at it. And you can look at that on your own since you guys do have the slides. We did this pop quiz yesterday. Y'all got it right because you're awesome. All right, so multi-state. Multi-state can be super fun. And Michelle has more experience than all of us on locals, but she probably has multi-locals in Pennsylvania, which is probably just as painful, if not more painful than multi-state. And so anyways, for multi-state, you have to figure out, first of all, which laws of the states do you follow? So how do you determine who is a resident and whether you should follow the laws of the state of the residents or the state of where the services are performed? So from a basic rule of thumb, the default rule of state income tax withholding that can be used as a starting point is to withhold income tax for the state in which the services are performed. So if you can do that, great. It can be applied in most situations when the employee lives and works in the same state. It's pretty easy. If they live and work in the same state, you're going to withhold in that state. Now, if it's one of the states that does not have income tax withholding, and there are some, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming all do not have any state income tax. So if they do not have any state income tax in those states, then you obviously aren't going to withhold state income tax as long as they're living and working in that state. So nexus means a business connection. The word nexus literally means connection. Nexus is established by having a business presence in a state. So in the withholding context, the employer's concern is whether it has a business connection or any operations within a state. If it does, it is subject to the withholding laws of that state. This will make the difference in whether an employer must withhold income tax for an employee's state of residence, even though the employee performs no services there. If an employer does not have nexus with an employee's state of residence, but there is a reciprocal agreement between the two states, the employer must honor the reciprocity agreement and not withhold income tax for the state where the employee works. However, the employer is not obligated to withhold income tax for the state where the employee lives because the employer does not have nexus with the resident state. The employee will have to make estimated payments outside of payroll on their own. If an employer does not have nexus in a state for which one of its employees will have a personal income tax liability, it can choose to establish a withholding account in that state and begin withholding as a courtesy to its employees. Some employers choose to do that, others do not. I'm sure Michelle has to deal with reciprocity a lot more than we do. A lot of the states over here on the western side of the US don't have reciprocity at all. But those guys over there really, they like their reciprocity rules because they're much closer than we are over here on this half of the United States. So it's easier to live and work in a different state. Over here, our states are so big, you generally don't live and work in two different states as a rule of thumb. So I think that's why it's more common over on the East Coast. So withholding rule number 1, resident defined. The first determination that must be made is the state of residence of the employee. This is primary because a resident is subject to state withholding laws in their state, including its own income tax laws. Furthermore, states have varying policies on withholding from residents who perform services in another state and from non-residents who perform services within the state. So what gets tricky about this is every state has a different rule. There's 50 states, only 9 of them do not have withholding, which means there's 41 different rules that you have to learn to abide by. Depending on which states that you're in. So multi-state can be very complicated because of that. So withholding rule number 2 is reciprocity. If an employee performs services in a state other than the state of residence, you must find out whether the 2 states have a reciprocal agreement. A reciprocal agreement allows you to withhold only for the state of residence as opposed to the state in which the services are performed. So this is very popular, like I said, over on the East Coast, where the states are really close together, and it's very common for an employee to live in one state but work across the border in another state. So it is important that you know whether there's a reciprocal agreement between the two states, one for the state of residence and the state of work. Withholding rule number 3 is resident, non-resident taxation policies. If an employee is a resident of one state but performs services in another and there is no reciprocal agreement, you must consider the laws of both states. The correct determination of the state of residency, rule number 1, is very important in these situations because it tells you which state's laws you may need to consider in addition to those of the state which the employee works. So, for example, we're in Western Colorado. If an employee worked in Western Colorado but lived in Utah, then this would come into play because Western Colorado and Utah do not have reciprocal agreements. So we may have to consider the rules of both states. So as a quick example, a California resident works exclusively in Arizona for 6 months, and if the employee has nexus with California, Arizona withholding is required. The 60-day threshold is exceeded. That's what I'm talking about, where every single state has a different rule as to when and if you have to withhold. Some states say, if you're only going to work in my state for a few days, I don't even want to know about it. Other states, on the other hand, say, if you step foot in my state and perform a service, I want your tax money. And it just depends on the state, and every state is different, which is what makes this a very big challenge. So if this person is in Arizona for 6 months, then the 60-day threshold for Arizona is exceeded. And California also wants their withholding because that is where the employee lives. Now, because they're going to pay some to Arizona for where they're working, then they get a credit for that in California for what they paid to Arizona. Okay. So in that situation, the employer must first calculate and withhold Arizona income tax. The employer must then calculate California income tax on the same wages. And if the California tax is greater, they must then withhold the amount equal to the difference between the California tax and the Arizona income tax. So they have to withhold that extra amount and send it to California. If the California tax is less than the Arizona tax, then they don't have to send anything to California because the tax that they paid in Arizona was exceeding what they would have paid had they been in California. If, however, the employer does not have nexus with California, the employer is not subject to the laws of the state and is not required to withhold that state's income tax. However, the employee may have personal income tax liability on these and all other wages earned by virtue of being a resident of that state. So that becomes the employee's responsibility. At the end of the year, when they have to go file their taxes, they need to work with their accountant and figure out where all they lived, where all they worked, all throughout the year, where they paid taxes, and make sure that everything is paid according to how it should be. So if an employer withheld both, great, but it doesn't necessarily have to withhold both depending on whether you have nexus in the state or not. Railroad employees, I'm not going to go into a super ton of detail on this, but basically railroad employees have the exact same taxes as normal employees. It's just that they're part of a different tax act, and so they're named differently. But it's very similar to the same taxes that normal employees have to be withheld. So railroad employees are subject to a separate and distinct system of employment taxes for FICA and unemployment, and they're just specific to railroad retirement. So that replaces the Social Security for railroad workers. So similar to how we talked about yesterday, how Colorado has some employers that participate in PARA, or a retirement plan that replaces Social Security. That's what this retirement is, the same thing. So involuntary deductions or withholding orders, child supports, garnishments, things like that. So let's talk about those a little bit. Withholding orders, a garnishment is a legal proceeding authorizing an involuntary transfer of employees' wages to satisfy a debt or other obligation. The employer is required by law to deduct or garnish a certain amount of an employee's pay and send it to a court, a person, or a government agency to satisfy a debt owed by the employee. Failure to deduct and remit will generally subject the employer to a penalty equal to the amount required to be deducted, plus potential fines and interest. So be careful, make sure you're withholding, make sure you're remitting. once you withhold, you have to actually send it to wherever it's supposed to go in order to not be in trouble as an employer. So as an employer, you have to, claims are valid and amounts stated on the orders are correct by contacting the agency. So if you receive an order, you need to make sure it's valid. You need to make sure that the amounts stated on the orders are correct by contacting the agencies or courts issuing the orders. They need to tell their employee about the order to make sure the employee has received a notice about the impending order and has had the chance to object. So the employee shouldn't be surprised. So make sure that the employee has a copy of the order. Tell their employee about any exemptions that might apply under state or federal law. They must tell their employee how the order will affect their wages and net pay. They must determine whether the amount of the order exceeds the maximum allowed by federal or state law. Determine the order of priority for the deductions if an employee is already subject to one or more orders, and determine how the employee's available disposable earnings must be allocated between the orders. So if they have multiple, how are we going to allocate? And then they must contact legal counsel to review the order and answer any outstanding questions if that is necessary. Child supports, as most of us know, their child supports are kind of king. They come above most other income withholdings. They generally, the federal law says that you can only withhold 50% of the employee's disposable earnings if the employee is supporting another spouse and or dependent children. So you can't take all of their wages for a child support order. You can only take up to 50%. If the employee is supporting a spouse and or other dependent children. You can take up to 60% though if the employee is not supporting another spouse or dependent children. Both of those amounts increase to 55% and 65% respectively if the employee is at least 12 weeks late or in arrears, as it is stated on most child support orders for those child support payments. States can have less strict laws, meaning I think Colorado only allows you to take up to 50% now. They don't allow you to go anything above that. So states can allow the employee to take home more than this federal law is stating. So based off of those numbers that we just talked about, pop quiz, and don't forget to put your answers in chat in the window so that we can make sure that you get credit for RCH if you would like for today. An employee who is not supporting another family has semi-monthly disposable earnings of $1,200 and is more than 12 weeks in arrears on child support payments. Calculate the maximum amount per pay that can be deducted from the employee's pay for child support. Again, not supporting another family, disposable income is $1,200. So you're gonna have to figure out what percentage per federal law you are allowed to withhold. And then do math. I lost my chat window. Did everybody chat?
Yes, and the consensus is 780.
You guys are awesome. Good job. All right. So when an order takes effect, that's dictated by state law. I know that Colorado recently changed their laws, but it is dictated by state law. So that's not going to be something that comes down from the feds. That's going to be individual per the state. Employers must continue to withhold until notified otherwise in writing by the court or agency involved. So they can't just stop taking the child support order because they want to, because the employee asked them to, any of that. Make sure that you're withholding until you are presented with a notification stating that you no longer need to withhold. Combining payments for several employees. Employees may combine payments from several employees and send one check or electronic payment each pay period. So you can put them all on one check or payment. Administrative fees for employers. Employers may charge employees an administrative fee for processing wage withholding orders each pay period. The maximum amount is set by the state, and the fee must be withheld from the employee's other wages, not from the child support payments. I think in Colorado, it's $5 per month, not per order, per month. Notification after an employee leaves employment. So if an employee whose wages are subject to a child support withholding order separates from employment for any reason, the employer has a certain amount of time set by state law to notify the agency of the employee's last known address, and if known, the name and address of the employer's new employer. So if the employee left and went to someone else and you know who they're employed by now, you can provide that to the agency. As I already talked about, there's penalties for not withholding. So make sure that if you do receive an order, you are withholding according to the requirements. The notices are all, they look the same, basically. If you receive a notice, they all look very, very similar for a child support order. And it's a uniform notice. Acceptable changes to IWO. IWO stands for Income Withholding Order. There can be a different font, all kinds of little stuff like that, but the format is always the same. An employer should contact the child support agency in the state that issued the underlying support on an order on a case-by-case basis to request a revised income withholding order directing payment to the SDU. The employer should continue to send payments to the non-SDU address until the state CSE agency or sender issues a revised IWO. So just make sure you're sending it to wherever the payment is required to be sent. So this gets more complicated if an employee has multiple orders. So if an employer receives more than one child support withholding order for an employee, state law governs how the orders must be handled. Again, state law is going to make that determination, not federal law. So different states handle it differently, but a couple of different methods. The first method is to allocate the available wages to each order depending on its percentage in relation to the total amount required to be withheld. It's called the prorate method. The second method is to allocate the available wages equally to each order until each order is individually complied with or the maximum amount of available withholding is reached. This is the allocate equally method. Certain support must be calculated before amounts past due or arrearages. When medical support has been ordered, the state may require its satisfaction after child support obligations. Yeah. So a couple of examples. Tim's employer receives a child support withholding order requiring $300 to be withheld from Tim's weekly pay. The maximum amount that can be withheld from Tim's pay under federal and state law is $275. This causes Tim to be $25 in arrears each week. Also, the state where Tim works allows employers to withhold $5 for an administrative fee each time child support is withheld. If Tim's employer wants to collect the administrative fee, it can withhold $270 for the current child support, take the $5 fee from Tim's remaining wages, and that would increase Tim's weekly arrearages to $30. So that is allowed. A separate example, if we receive one child support withholding order for an employee, George, who works in Indiana on September 8th, demanding $450 per pay period, and a second order on November 17th in the same year, demanding $300, the company determines the maximum amount that can be withheld from George's pay under Indiana law is only $600. Indiana law requires a prorated allocation when the total to be withheld exceeds the maximum amount allowed. So again, on this slide back here is the prorate method. We have to allocate the available wages to each order depending on its percentage in relation to the total amount required to be withheld. So we need to withhold $750, but we're not going to be allowed to. So the first order said we needed $450. So if we turn 450 out of 750 into a percentage, it's 60%. So that means 60% of the maximum amount available to withhold, $600, is going to be what we're going to give to that first child support order, or $360. And then for the second, it's going to be the remaining 40%. So 600 times 40 is 240. If you add those together, you get the full 600 max for that calculation. Different scenario, same facts, but now let's say that George works in Texas. Texas is a state which requires the available wages to be allocated equally instead of the prorate method. So we're going to take our child support orders and we're just going to allocate equally. So we're going to put 300 to one, we're going to put 300 to the other until we are at the $600 max. Questions on those? Child support's always fun. Disposable earnings, the easiest way to remember disposable earnings is it's subtracting all of the deductions required by law from an employee's gross earnings. So to calculate disposable earnings, you're not going to take their pay and subtract everything that's supposed to be deducted from their check to find their disposable earnings. You're only going to take deductions that are required by law. Taxes, those are required by law. Health insurance, not required by law. So you have to be a little careful when calculating disposable earnings. Medical support orders sometimes come with child support orders, and an employer must withhold premiums from the employee's pay to the same extent as the other employees with similar coverage. So if you offer health insurance to your employees and you get an income withholding, a medical support order with an income withholding order, you do have to comply. So as another example, in the chart below, the first column lists the type of deductions from Steve's gross earnings, while the second and third column show which amounts are deducted in calculating Steve's net pay and disposable pay, respectively. So Steve's year-to-date Medicare wages are $50,000. So his net pay versus his disposable pay, his gross earnings were $1,950. 401k is not going to come out when you're calculating his disposable earnings. That's not required by law. Same with the FSA deduction. On the other hand, income tax is required by law, so that is going to come out when determining his disposable pay. So that includes all of the taxes, federal, Social Security, Medicare, and state. Also, if there was any locals or anything like that, those would also be taken into account before when calculating disposable earnings or disposable pay. Okay. Does everybody understand the difference between disposable earnings and net pay? Cool. If you receive a national medical support notice, it requires the employee the employer to do what? Don't make this harder than it is. If you receive an order as an employer, you have to honor the order. That's what you have to do. Okay. Perfect. A couple more examples of talking about disposable earnings and child support orders. So Terry's employer receives a child support withholding order demanding $700 of Terry's disposable earnings be withheld each pay period and sent to the state child support enforcement agency. 350, that's biweekly, 350 if the payment is weekly. The state where Terry works follows federal law in determining the maximum that may be withheld for child support. So those percentages that we talked about earlier, his state follows that. So we're going to use those percentages. He is not late in paying child support and is supporting another spouse or is not supporting another spouse or child, sorry. Terry's disposable earnings and the amount withheld for the child support would be as follows. So he's earning $1,600. Taxes come out first. Those are required by law. So before we take our calculation of percentage, we take those amounts out. The health insurance is not required by law, so it's not going to be taken out when determining disposable earnings. Same with 401k, same with a charitable contribution. So the withholding maximum that we can do for this employee is going to be 60% because he's not supporting another family and he's not, let's see, he's not in arrears, so it doesn't go up to 65. So we're going to do 60% of his disposable earnings, which gives us $680.05. Since the state withholding maximum is less than $700 demanded in the withholding notice, then only $680.05 can be withheld from Terry's pay for child support. Ronald's employer receives a newly issued child support order while Ronald's wages are already subject to a federal tax levy under which his employer is currently withholding 45% of Ronald's disposable earnings every 2 weeks. His disposable earnings are $1,000. The original issue date of the child support order does not predate the federal tax levy. So for purposes of this example, we're going to assume that his disposable earnings and his take-home pay are the same. Ronald is not supporting another spouse or children other than those mentioned in the child support order, and he is not more than 12 weeks in arrears in making child support payments. So Ronald's disposable earnings remain at $1,000 after the child support order is received, but his employer may only deduct 15% or $150 of Ronald's disposable earnings to satisfy the child support withholding order, because the most that we can take is 60%. But $450 is already going to the federal tax levy. So we can't take more than 60%. So we're going to take that $450, continue to send it to the federal tax levy. We can then take the remaining $150 and send it to the child support order because that doesn't exceed the total 60% or $600 of his $1,000. Federal tax levies, employees who fail to pay their taxes on time and may become subject to a federal or state tax levy. We don't see a ton of these, but we do see some. The amount of the employee's wages subject to the levy is determined by the employer, and then whether there are other claims to the employee's wages that take priority over the levy. So the employer has to decide what order these things should be withheld in, and we'll talk about that a little bit more in a minute. Exemptions from levies. All payments made to employees are subject to levy unless specifically exempt under the Internal Revenue Code. There are a few exemptions. Employees are entitled to an amount exempt from a levy equal to the amount of the employee's standard deduction, the number of dependents multiplied by an exempt amount of 4,300 for 2020. And I don't think that's changed for 2021, but I should probably go look. So there's a table to determine this, and we'll look at that in just a second. So take-home pay is the amount of an employee's wages that remains after all normal deductions in effect at the time of a levy is received have been subtracted from the employee's gross pay. The IRS has ruled the following items may be subtracted from an employee's gross wages when calculating take-home pay: all taxes, federal, state, and local, involuntary and voluntary deductions that were in effect before the employer received the levy, increases in pre-existing deductions beyond the employee's control, including those caused by increases in the employee's pay, such as elective deferrals of a certain percentage of salaries, and those caused by increase in the cost of benefits. So if your health insurance cost goes up, that can be exempt, unexempt. Like you can go ahead and take that amount before you determine the amount of the federal tax levy to be withheld. Deductions instituted after a levy is received and made as a condition of employment, such as a required deduction for union dues or something like that. So this is a deduction that is required, but may come into play after the levy is received. So let's look at an example. Arthur receives $2,400 semi-monthly from his employer. On August 1st, he received a federal tax levy was being issued against Arthur's wages for $25,000. Arthur claims married, filing jointly with 3 dependents on part 3 of the form and gave it to the payroll department. As of August 1st, Arthur's year-to-date Medicare wages were $40,000, and he had the following deductions. So these were all in place at the time the federal tax levy was received. So in order to determine his take-home pay, this nice little chart is provided on when you receive a federal tax levy, and it tells you what the amount that the person is allowed to take home. So this person's paid semi-monthly and they have 3 dependents. So we're going to look at the column where semi-monthly and 3 crisscross, and we get $1,570.84. So that's the amount that he needs to be able to take home. So therefore, $303.04 are going to be able to be sent for the federal tax levy. To get to that number, we're taking his gross pay, subtracting all of his taxes and everything that was in place at the time the federal levy was received. Then he gets to take home that amount, and anything left over is going to go to the federal tax levy. So in this case, it's $303.04. On October 1st, Arthur, the employee, provides a new form 668-W, Part 3, and he's going to increase his dependents on that form. So his year-to-date wages, Medicare wages, are now $50,000, and his deductions have changed to the following amounts. So after, if we look at his deductions and everything we're going to take, so the 401k changed from $72 to $120 when he changed his elective deferral percentage from 3 to 5. His health insurance deduction increased from 45 to 55 when the premiums were raised, although he was receiving the same coverage as before the increase. In calculating Arthur's take-home pay, the employer cannot subtract the $48 increase in the 401k from gross wages because it was the result of a voluntary increase in the elective deferral percentage after the levy was in effect. The $10 increase in the health insurance deduction may be subtracted because it was the result of an increase in cost of coverage, not a change in coverage chosen by Arthur. So does that make sense? He chose to increase his 401k deduction from 3% to 5%. So that was his decision. That means his levy is not going to be affected by that. In other words, they're still going to take the max amount, and that amount doesn't get to be deducted. The $10 though, that was not his choice. The premiums increased for his health insurance. So because it wasn't his choice, that was a required increase in the premiums. That amount can be subtracted before determining the amount that goes to the federal tax levy. Questions on that? Okay. So an employee earns $2,267.52 semi-monthly and has a creditor garnishment of $30 when a federal tax levy of $10,000 is received. The IRS exempts $695.84 each pay period from the levy. So that's what they found in that table that was on the previous page. The employer's combined withholding for federal income, Social Security, and Medicare taxes is $672.32. So we want to know how calculate the amount to be deducted for the federal levy. So I see a couple different answers, and I know the difference between your answers. Some of you said $899.36 and some of you said $869.36. The answer is $869.36, and the difference is that $30. It can be subtracted because it was in place when the federal tax levy was received. So the correct answer is in fact $869.36. Good job. Questions on that? If the $30 was not in place when the federal tax levy was received, it would be a different story. But because the federal tax levy was received when that $30 was already in place, then it also does get subtracted. Good job. Creditor garnishments are slightly different. Most of the time, the amount that can be garnished is 25% of the employee's disposable earnings for the week. The amount that the employee must take home, though, has to be a minimum of 30 times the federal minimum wage or the state minimum wage, whichever is higher, for a weekly calculation. So if you were bi-weekly or semi-monthly or anything like that, you would have to increase that amount respectively. And the creditor garnishments have those calculations on them. Okay. So Michelle's disposable earnings for a week are $245 when her employee receives a garnishment order on January 9th, requiring that $300 be withheld. Under federal minimum wage, the maximum amount of Michelle's disposable earnings that can be garnished is determined as follows: 25% of 245, which is 6125, or 725 times the federal minimum wage is $217.50. 245 minus 217.50 is 27.50. So it has to be the lesser of those two amounts. So the 27.50 is much smaller than the 25% of her disposable earnings. So we can only take 27.50 for the garnishment. Basically, employees have to receive, the whole premise behind it is employees have to receive a certain amount of money in their pockets each week to be able to live. So you can't take all of it for the garnishment. Okay. Another quick example, Josephine's disposable earnings for semi-monthly period are $550 when her employer receives a garnishment order on January 12th, requiring $150 be withheld. The maximum amount of Josephine's disposable earnings that can be garnished are as follows. If we look at 25% of the $550, we get $137.50. On the other hand, if we look at $550 minus $471.25, which is the amount subject to garnishment under the garnishment table that'll be on the chat or on the income withholding order, then you have to take the less of the two. So $78.75 must be deducted. So we have a couple more examples here. I'm not going to go through them. I'm going to let you guys go through those on your own in the PowerPoint, just because I want to make sure we get through this. So other garnishments that we haven't really talked about yet are bankruptcy garnishments, federal student loan orders, and federal agency garnishments. Federal student loan orders, I know those were put on hold back when COVID first started. Has that been lifted yet? I don't even know. I think they're still on hold, aren't they? Yeah, I think they're still on hold. So, and federal student loan garnishments are generally only 15%. You can only take 15% of disposable earnings for those ones. But like I said, I do think that those are on hold right now because of COVID. So again, like I said, I'm not going to go through these examples because I want to make sure we get through all of this, but you guys can go through them. So the priority of withholding orders, bankruptcy orders, each order is unique and can stop employers from withholding other involuntary deductions except for child support orders. So you cannot, yes, Dolby, I will take your question at the end. So you can't stop child support orders for bankruptcy orders, but they can potentially stop other orders. Child support orders deductions are not stopped by a bankruptcy order. Those continue, and they have priority over all other garnishments except for federal tax levies predating the original establishment date of the child support order. So basically, child support is king. It's going to take priority unless you have a federal tax levy that's predating the child support order. So 9 times out of 10, child support is king. It's going to take over. Those are really important. So creditor garnishments, also known as a writ or a wage attachment, they are usually the lowest priority. So unfortunately, those child supports and tax levies and things like that are going to take precedence over those creditor garnishments. Unless you have a creditor garnishment like we saw in that example a couple of slides ago, that was already in place when a federal tax levy was received. But child support is king. That's pretty much huge. Federal administrative garnishments are non-tax garnishments from any federal agency. They can include federal loans. They have priority over other garnishments served on the employer subsequently. Child support orders served anytime have priority over these federal. So again, child supports are king. They come above these. Federal tax levies are priority over other garnishments except child support. Again, child support is king. I know I've said that a million times. That being said, a federal tax levy can be stopped by a bankruptcy order. Local tax levies have priority over creditor garnishments. State tax levies have priority over local tax levies and creditor garnishments. And student loan garnishments, child supports are always higher priority than student loan garnishments, but no other priority guidance is given on federal student loan orders. State issued student loan garnishments may contain specific instructions. So bottom line, read the order, make sure you're complying. And if you have questions, reach out to an attorney to make sure you're withholding correctly. An employee's disposable pay is $750 with involuntary deductions received in the following order. I can't speak this Friday. $175 federal tax levy, $125 property tax levy, $75 state tax levy, $50 creditor garnishment. Which involuntary deductions has first priority? You guys are awesome. Federal tax levy, absolutely. Good job. So FLSA and garnishments, it places its own restrictions on the deductions that can bring an employee's wages below minimum wage. So you want to be careful and make sure that you're not bringing a employee's wage below minimum wage. When an employee voluntarily accepts meals, lodging, or other facilities provided by an employer for the employer's benefit, the reasonable cost of the facilities may be deducted from wages to the employee, even if the deduction results in an employer receiving less than required minimum wage. But on wage attachments or garnishments, you have to be careful about that. So just make sure that you're following those guidelines. Calculations of net pay. So net, we already talked about it a little bit, but the difference between net pay and disposable earnings is net pay is what's left over after you take all deductions versus disposable earnings is what is left over after you take only deductions required by law. So which one's going to be higher? Most likely disposable earnings is going to be higher than net pay. Yes, ma'am.
So they also use the terminology of take-home pay. Is take-home pay and net pay the same?
Yes. Great question. Net pay is more formal, but yes, great question. That's a good way of thinking of net pay is take home. And I usually say, which is really informal, but I say, what does the employee put in their pocket? That's their net pay. What are they putting in their pocket? Pop quiz, the formula for calculating employees' net pay is, oh gosh, we just talked about this. And again, net pay, take home pay, in what's in your pocket. How do we figure that out? Even though they're not lettered A, B, C, and D, you can all figure out which one's A, B, and C, and D, so you don't have to type all those in. You guys are awesome. We're going to take our gross pay, we're going to subtract our taxes, and then we're going to subtract any other deductions that we have. Very good. Oh, I guess that's it.
I had one question from yesterday, but you guys can go with questions for today first. Mine's small. Oh, yeah.
Dolby ladies, are you ready with your question?
Sure.
Yeah, it's a 941 worksheet question.
Okay.
Is that fine?
Yeah.
Got it, Jana?
Yeah. What's the difference between non-refundable credit and the refundable credit? Besides the fact that one's non-refundable and one's refundable. How do we make that determination?
So so for the rest of you, this was not on yesterday's. This is a completely separate question on the 941. So basically it's all refundable, but you can't double dip. So the worksheet 1 is the worksheet that I've had most experience with because it's been around long enough, or longer than all the rest of them. Worksheets, all the rest of the worksheets that came out this year, I don't have as much experience with in terms of talking about them, but you can only take a certain amount of credit back in terms of you can't double dip. So whatever credit you took for the FFCRA, you can't double dip and take the same credit on the ARPA. Does that make any sense?
So is she taking a credit in part 1 of that?
Melissa, is the difference that like
No.
the credit that you've already taken, like it's all refundable tax credit, but I've already taken 500. So that's now non-refundable and I'm applying for 700 more because that's what I've calculated that I'm still due
Yes.
on my refund.
Where it gets confusing is that all the credits are coming out of the same bucket. So even though they're separate credits, they're all coming out of the same bucket. And so that's what the worksheet is designed to do. It's designed to say at the very top, I paid this much in Social Security tax and I've taken this much credit and I now have this much that I need, this much more credit that I need to take. Do I have enough credit in my bucket after all of these different credits are calculated to be able to take that?
So, I mean, are we still doing FFCRA wages?
Yes. Well, they call it something different now. It's called ARPA, the American Rescue Plan Act. It's different in the fact that FFCRA was non-taxable for Social Security to an employer, but it was taxable for Medicare. So when you calculated your credit, you got back the amount of the wages plus the amount of the Medicare that you paid on that wage. Now, as of April 1st, we threw that out the window and we called it something else. We gave it a different name. And now we're going to calculate it different because we're the IRS and we need to make your life complicated. So now they made it taxable fully to the employer. So it's now taxable for both Social Security and Medicare. So now that means your credit that you get back is now the wages plus both Social Security and Medicare taxes. So yes, it's the same as FFCRA in that it's a credit and it's for the same reasons, except for the ARPA added a couple of reasons. So the FFCRA didn't say that you could pay employees to go get a vaccine, but the ARPA says you can pay employees to go get a vaccine. The ARPA also says that you have to give employees time off if they have a reaction from the vaccine and they need to be home or not at work to take care of that. Same for if they have an employee. We've been talking about employees all day. If they have like a kiddo or a dependent that they're caring for at home that got sick from the vaccine. So the ARPA extended the reasons for leave available from FFCRA. It's the same in the fact that you as an employer get the full wage amount back plus the amount of tax that you paid on it. It's just that it became taxable for Social Security when FFCRA was not taxable for Social Security. It was only taxable for Medicare.
Okay. So then is it possible to get to the bottom of worksheet 3 and have a zero refundable portion, even though we had sick wages paid out?
I wouldn't
That-
think so.
Because that's
Can
what's
we, do you guys have time after this meeting to chat?
Yeah.
Yeah,
Yep. Darby, do you want to call me? I'm working remote, obviously. So call me after we're done.
okay,
We'll go through it together.
that'd be great. Thank you.
Michelle, what was your question from yesterday?
Yeah, mine was small, but I was looking back. It was on that compensation over $1 million with, it was that small page.
Okay.
Hang on.
We'll let you know.
The example that was listed, it was listing that the employee like worked at one employer for X amount of dollars and then another employer in the same year.
Mhm.
How, okay, example, at the airport, someone comes on board. We have an executive director. She comes from another airport. We don't track what she made at a previous employer.
Sure. So that example.
So how
was-
can that be a federal, I mean,
that example was specific because the employers were related, meaning they would know that the employee worked for the other EIN. They were common ownership or something like that where they were related.
yeah, because we're not required to know.
No, absolutely not. It's just like the same with a social security limit. If an employee works for another company for the first half of the year and reaches that
Right.
social security limit, you as an employer are not required to know that. You wouldn't.
I didn't know this was a different, I was like, whoa, this is, yeah, I
No.
went back and went, wait a minute. It kind of went, because I'm thinking of if our CEO of the airport, calendar year
Yeah.
reaches that threshold, and then the last 4 weeks, she's making 100,000 more, that's the part that's subject to the additional. But then I look back
Correct.
at the
But you're not
example,
gonna know that.
right,
You wouldn't
and
know
I
that?
was like, is that a new thing to require to know? Okay.
You would not know that. And basically it's going to fall in the employee's lap when they do their income tax return. And that's where everything is sorted out.
It washes
You
out
as the-
anyway.
You as
So
the
true.
employer are doing your best to withhold
Yeah.
what you think you should.
Right.
And that's kind of why they make that limit so high. They're saying you're going to withhold 37% because if that person's making that much money, they're going to owe tax. So you might as well put as much in as you can. But if you don't know that they've made that much money, there's no
It'll
way.
wash out at the end. At the same time, what we also didn't know, because I talked to my payroll manager, and he was like, whoa, and I'm like, I know, that's weird. So no, we're good. That's it.
Perfect. All right, guys. Happy Friday. Darby, give me a call. Talk to you momentarily.
Thank you.
Thanks.
Thanks, guys.